Introduction to Gold ETFs. Imagine standing on the floor of the New York Stock Exchange in 2006. A new ticker appears on the screen, GLD. At first glance, it might look like just another financial instrument, but in reality, this moment marked a fundamental shift in how the world interacts with gold. For centuries, gold was something you held physically, coins, bars, stored in vaults, but now suddenly anyone could gain exposure to gold with just a click, just like buying a stock. This was revolutionary. GLD made it possible for the average investor to own a fraction of physical gold without worrying about storage, insurance, or transportation. It transformed gold from a heavy physical asset into something fluid, accessible, and instantly tradable. This was not just innovation, it was a complete redefinition of gold ownership. Why ETFs matter? So, why does this matter so much? Before ETFs, investing in gold was complicated. You had to buy physical metal, deal with premiums, and find a safe place to store it. For many people, that was simply too inconvenient or too expensive. ETFs removed all of these barriers. Suddenly, gold became accessible to everyone, not just institutions or wealthy individuals. You could buy it through your regular brokerage account in seconds. It also made gold part of everyday portfolio management. Investors could now easily rebalance, adjust exposure, and react to market conditions without friction. Even more importantly, ETFs opened the door to global participation. Investors from different countries, backgrounds, and income levels could now include gold in their portfolios. This dramatically increased demand and changed how gold behaved as an asset. Overview of the report. In this presentation, we're going to explore this transformation in depth. We'll start by looking at where gold ETFs came from and how they evolved. Then we'll break down the mechanics behind them, especially the creation and redemption process that keeps prices aligned with the market. We'll also analyze how money flows into and out of these ETFs and how that directly influences the price of gold. Because understanding gold today is no longer just about mining or jewelry demand. It's about financial flows. Finally, we'll compare ETFs with physical gold. Each has its strengths and weaknesses, and knowing when to use one over the other is crucial for any serious investor. By the end, you'll see that gold ETFs didn't just make investing easier, they fundamentally reshaped the global gold market. History of gold ETFs. When people think about gold ETFs, most immediately think of GLD. But the story actually begins earlier and in a different part of the world. The first gold ETF was launched in Australia in 2006 under the name Gold Bullion Securities. This was the true pioneer. It introduced the idea that physical gold could be packaged into a tradable financial product. Investors could gain exposure to real gold without ever touching it. This idea quickly proved successful and began spreading to other financial centers like London and eventually the United States. The concept was simple but powerful. Make gold easier to access, cheaper to hold, and standardized across markets. And once this model proved it worked, adoption accelerated rapidly across the globe. Role of organizations. But this transformation didn't happen by chance. Key organizations played a major role, especially the World Gold Council. Their mission was to promote gold as an investment, and they understood that accessibility was the biggest barrier. They supported the development of ETFs by providing research, data, and education. They helped investors understand why gold matters in a portfolio as a hedge, as diversification, and as a store of value. By doing this, they reduced uncertainty and built trust. Investors weren't just buying a new product, they were adopting a new way of thinking about gold. This institutional support was crucial. Without it, ETFs might have remained a niche idea instead of becoming a global standard. Impact on investors. The result of all this was a dramatic shift in investor behavior. Gold ownership became easier than ever before. Instead of dealing with physical logistics, investors could now simply buy and sell shares. This also standardized how gold was used in portfolios. It became a regular allocation, just like stocks or bonds. Portfolio managers could now include gold strategically, adjusting exposure based on market conditions. And perhaps most importantly, global demand increased significantly. Because when something becomes easier to access, more people participate. And when more people participate, the entire market changes. Gold was no longer just a traditional safe haven asset. It became a dynamic, liquid, and actively traded financial instrument. Structure of GLD. Let's now take a closer look at how GLD actually works behind the scenes. At its core, GLD is not just a typical financial product. It is a structure built around real, physical gold. When it launched in November 2006, it introduced a system where each share represented a fraction of an ounce of gold. This gave investors precise exposure to gold prices without needing to handle the metal itself. But what makes this especially important is that GLD is backed by real gold bars. This means that when investors buy shares, they are not just buying a promise. They are buying a claim tied to actual physical assets. Over time, due to fees, the exact amount of gold per share slightly decreases, but the fundamental concept remains the same. It is a bridge between financial markets and physical gold. This structure gave investors confidence. It wasn't abstract or synthetic, it was grounded in real, tangible value. And that is a big reason why GLD quickly became one of the most trusted gold investment vehicles in the world. Gold storage. Now, where is all this gold actually stored? The answer lies in London, one of the most important gold trading hubs globally. The gold backing GLD consists of LBMA good delivery bars, large standardized bars weighing around 400 ounces each. These bars are stored in highly secure vaults, primarily managed by major financial institutions like HSBC, with additional support from other banks such as JP Morgan. This setup ensures both safety and operational reliability. The use of standardized bars is crucial because it guarantees quality, authenticity, and global acceptance. Every bar meets strict criteria, making it suitable for international trading and settlement. For investors, this means that their exposure is tied to gold that meets the highest global standards, not just any gold, but investment-grade metal recognized worldwide. Importance of structure. Understanding this structure is essential because it highlights what GLD truly is and what it is not. It is not simply a paper asset with no backing. It is a physically backed trust whose value is directly linked to real gold stored in vaults. However, there is an important limitation. Retail investors cannot walk into a vault and withdraw gold bars. Only large institutional players, known as authorized participants, can exchange shares for physical gold in large quantities. For most investors, this means that participation remains within the financial system, buying and selling shares rather than handling physical metal. Even so, this structure strikes a balance. It combines the security of physical gold with the flexibility of modern financial markets, making it one of the most efficient ways to gain exposure to gold today. Alternative ETFs. While GLD was the pioneer, it didn't remain alone for long. Competition quickly emerged, most notably in the form of IAU, launched by BlackRock. This product offered a similar exposure to gold, but with a key advantage: lower fees. This created a new dynamic in the market. Investors were no longer choosing just whether to invest in gold, but also how to invest in it. Cost became an important factor, especially for long-term investors. IAU positioned itself as a more cost-efficient alternative, appealing to those who wanted exposure to gold without paying higher annual expenses. This competition pushed the entire market forward, encouraging innovation and better pricing. Introduction of GLDM. As the market evolved further, SPDR introduced GLDM, a newer and more affordable option. Designed with long-term investors in mind, GLDM focuses on minimizing costs while still providing reliable exposure to gold. Its lower expense ratio makes it particularly attractive for those who plan to hold gold over extended periods. Even small differences in fees can have a significant impact over time, especially in long-term portfolios. However, this comes with a trade-off. GLDM may have slightly lower liquidity and wider spreads compared to GLD. This means it might not be ideal for active traders, but it is highly suitable for disciplined, long-term strategies. Choosing between ETFs. So how do you choose between these options? It ultimately depends on your investment style and priorities. If you value maximum liquidity and tight trading spreads, GLD remains the top choice. It is widely used by institutional investors and traders who need speed and efficiency. If you are looking for a balanced approach between cost and liquidity, IAU offers a strong middle ground. And if your focus is long-term investing with minimal costs, GLDM stands out as the most economical option. Each of these ETFs serves a different purpose, and understanding these differences allows investors to make smarter, more tailored decisions based on their goals. Creation mechanism. Now we move into one of the most important concepts behind gold ETFs, the creation mechanism. This is what allows ETFs like GLD, IAU, and GLDM to function efficiently and stay connected to the real gold market. When demand for ETF shares increases, something very specific happens behind the scenes. Large financial institutions, known as authorized participants, step in. These participants deliver physical gold into secure vaults. In return, they receive newly created ETF shares, which they can then sell on the market. This process ensures that supply increases when demand rises. It prevents ETF prices from drifting too far above the actual price of gold. Without this mechanism, ETFs could easily become disconnected from reality, trading at significant premiums. What makes this system powerful is that it operates continuously and automatically, driven by market forces. Investors don't see it happening, but it is constantly maintaining balance in the background. Redemption mechanism. On the other side, we have the redemption mechanism, which works in the opposite direction. When demand for ETF shares decreases, authorized participants can return shares to the issuer. In exchange, they receive physical gold from the vaults. This gold can then be sold in the open market or used elsewhere. As a result, the number of ETF shares decreases. This process ensures that supply contracts when demand falls. It helps prevent ETF prices from dropping too far below the actual gold price. Together, creation and redemption act like a balancing system. They expand and contract supply depending on market conditions, keeping everything aligned. Price alignment. This leads us to the key result of these mechanisms. Price alignment. Because authorized participants can profit from arbitrage opportunities, they are incentivized to act whenever ETF prices deviate from the spot price of gold. If the ETF trades above the gold price, they create shares and sell them. If it trades below, they buy shares and redeem them for gold. This constant arbitrage activity keeps ETF prices very close to the real market value of gold. This is why gold ETFs are considered reliable tracking instruments. Investors can trust that what they are buying closely reflects the actual price of gold. In essence, this system transforms a complex physical market into something that behaves like a highly efficient financial instrument.